In June, Leopold Aschenbrenner's AI hedge fund was reportedly up 439% for the year. Weeks later, lenders demanded cash, public positions were dumped, and Citadel bought the portfolio in a fire sale. The technology did not disappear. AI demand did not go to zero. So, how did one of the market's biggest AI winners run out of time? The answer is not simply that Aschenbrenner was wrong about artificial intelligence. The deeper story is that a concentrated trade, financed with leverage, collided with a sudden change in market leadership. When the long positions fell, the protection did not work as expected. When lenders asked for cash, the fund could not wait for the long-term thesis to recover. This is the story of situational awareness, a fund that may have identified a real decade-long opportunity, but built a portfolio that could not survive a few weeks of adverse price action. The bullish AI story is easy to understand. Artificial intelligence could transform software, research, logistics, medicine, and nearly every knowledge industry. The companies supplying chips, electricity, networking, cooling, and data center capacity look like the picks and shovels of a new industrial revolution. That promise created a powerful investment pattern. Instead of trying to guess which AI application would dominate, investors could buy the infrastructure needed by all of them. Situational awareness built its identity around that opportunity. The fund was associated with companies connected to compute, data centers, power, semiconductors, and the physical machinery of AI. And for a while, the strategy looked almost unbeatable. But every infrastructure boom eventually faces the same question. How much of the demand is independent, profitable demand, and how much depends on financing, momentum, and the next investor paying a higher price? The clearest hard evidence comes from the SEC. Situational Awareness's filing for March 31st, 2026, reported 42 positions worth approximately $13.7 billion. But this was not a simple list of long stock holdings. Around 62% of the filing's reported value was in puts. Roughly 10% was in calls. Only about 28% was in non-option positions. The biggest reported puts included the VanEck Semiconductor ETF, NVIDIA, Oracle, Broadcom, AMD, Micron, Taiwan Semiconductor, and ASML. The largest reported non-option positions included Bloom Energy, SanDisk, CoreWeave, IREN, Core Scientific, Applied Digital, and Riot Platforms. The filing is only a delayed snapshot. It does not show every short, swap, private asset, or the fund's leverage, but it reveals the architecture, a large derivatives-heavy technology trade, surrounded by concentrated positions in the physical AI build-out. This was not one simple bet that AI stocks would rise. It was a bet on which part of the AI economy would win. The apparent structure was long infrastructure and selected compute beneficiaries, while using puts or short exposure against expensive semiconductors, software, and momentum names. In the right environment, that can be extremely powerful. The infrastructure stocks rise, the crowded software names fall. The hedge pays for the long book, but it also creates a hidden dependency. The trade needs the relationship between those groups to remain stable. It needs the long side to be strong enough, the short side to weaken, and the spread between them to widen. If both sides suddenly respond to the same liquidity shock, the hedge stops hedging. The portfolio may look diversified by ticker while remaining concentrated in one factor: AI momentum and the willingness of markets to finance it. Then the market's question changed. Investors began asking whether AI spending would convert into sustainable end demand, whether data center construction had moved ahead of utilization, and whether the most ambitious forecasts assumed too much financing and too little friction. The reversal did not require AI to fail. It only required expectations to fall. Reports say several core AI infrastructure holdings dropped between roughly 27 and 54% during July. At the same time, software stocks that the fund had reportedly shorted moved higher. That combination is toxic for a long-short portfolio. The fund lost on the long AI basket, and the short book failed to protect it. A strategy designed to profit from an internal rotation instead encountered a broad liquidity reversal. The market stopped rewarding the story. and the positions that had been most valuable during the boom became the positions everyone wanted to sell at once. Leverage changes the meaning of a drawdown. Without leverage, an investor can be early, wait, and see whether the thesis eventually works. With leverage, the lender decides how much time remains. Multiple reports describe situational awareness as operating with leverage near 4 times gross exposure. That figure is not confirmed by the 13F filing, but it explains the mechanics reported by people familiar with the unwind. If the collateral falls, the fund must provide cash or reduce positions. A 10% move in a highly leveraged book can create an equity loss many times larger than the headline index decline, and the losses do not need to reach zero. The lender only needs to decide that the remaining collateral is no longer sufficient. At that moment, a long-term investment thesis becomes a short-term liquidity problem. The question is no longer, will AI be worth more in 5 years? It becomes, can the fund meet tomorrow's margin requirement? The reported chain reaction is brutally simple. AI infrastructure stocks fall. The value of the collateral declines. Prime brokers demand additional margin or repayment. Private assets cannot be monetized quickly enough. The fund sells public stocks to raise cash. Those sales push prices lower, reducing collateral again. Then the cycle repeats. Reports from CNBC and the New York Times say lenders, including Goldman Sachs, demanded repayment or additional collateral as the book weakened. CNBC also reported that Citadel reached a deal to buy the fund's public stock portfolio. That is the hallmark of a forced unwind. The seller loses control over timing, size, and price. This is why a fire sale can happen even if the underlying companies survive. The fund is not selling because its 5-year forecast changed overnight. It is selling because its financing agreement gives the lender priority over its forecast. The headlines describe the collapse with enormous numbers, but those numbers need to be handled carefully. Reports cite a peak near $20 billion, another figure near $45 billion, and roughly $10 billion after the unwind. The SEC filing alone showed $13.7 billion of reported positions as of March. These figures may be describing different things: net asset value, gross exposure, total assets under management, public holdings, or assets remaining after liquidation. They are not automatically comparable, and they do not prove that investors lost the difference between two headline numbers. What is clear is that the fund's reported scale and public equity exposure contracted dramatically after the forced selling. The precise accounting matters, but it does not change the mechanism. The fund had a large, concentrated, financed book. The market moved against it. Lenders demanded cash. The portfolio had to shrink before the thesis had time to recover. There is a serious counterargument to the collapse narrative. Artificial intelligence may continue to create real demand. Data centers may remain scarce. Power, networking, chips, and compute may become more valuable as adoption broadens. A forced liquidation does not prove that AI is fake, that every infrastructure company is doomed, or that the fund's long-term thesis had no merit. In fact, the fund may have been directionally right about the importance of AI infrastructure. The problem was the path. A valuable technology can still produce terrible investments when expectations move too far ahead of cash flow. A strong company can still be a bad position when it is purchased with borrowed money at a crowded price, and a correct thesis can still lose when the investor is forced to sell before the economic payoff arrives. The fund's collapse is therefore not proof that AI has no future. It is evidence that financing and timing are part of the future too. So what actually failed? First, concentration. Many supposedly different holdings were exposed to the same AI capex and liquidity factor. Second, leverage. Borrowing amplified both the gains and the speed at which losses consumed equity. Third, correlation. The long infrastructure and short software legs moved against the fund at the same time. Fourth, liquidity. Private or difficult to sell assets could not provide cash when public markets demanded it immediately. And fifth, timing. The strategy needed years for AI economics to mature, but the financing structure may have allowed only days or weeks. This is the difference between an investment thesis and a portfolio. The thesis asks what will eventually happen. The portfolio must also survive the path. Situational awareness may have had a credible view of where AI was going, but it appears to have underestimated how violently the market could move before the destination arrived. The most important lesson is not that AI has no value. It is that value must arrive before the financing bill does. Investors should watch whether AI companies move towards self funding, whether customers diversify, whether data centers reach profitable utilization, and whether incremental cash flow justifies incremental capital spending. They should watch what happens when supposedly strong AI results no longer lift the stocks. One warning signal does not prove the thesis is broken, but funding stress, weaker commitments, rising capex, falling estimates, and forced selling together would describe a genuine breakdown in the trade. Situational awareness did not necessarily fail because its vision of the future was impossible. It failed because leverage turned a temporary reversal into a deadline. The technology may survive. The portfolio did not. In markets, being right about the destination is not enough. You also have to survive the journey.